Hey everybody, Keith YUEDE with the YUEDE team. First of all, wanted to thank everybody for taking their time to listen to us tonight. We've done several of these webinars in the past, and it's something that we really enjoy doing. We like to do a little bit of research on real estate and get the word out to our clients and others as much as we possibly can. As far as what's going on this year in 2012, we're pretty excited about what we're doing. We had a great year. We had a better year in 2012 than we did in 2011. In fact, we think that there is some evidence of a real estate recovery, believe it or not. There's still a lot of hurdles out there, and we're going to be talking and getting into some of that tonight during the presentation. But we think that it's a great time to buy. We think it's a great time to own investment property. We think that adding investment property to any investor's portfolio makes as much sense now, probably as it ever has, maybe?
I think so. I mean, we're also going to be doing some forecasting tonight as far as what they're anticipating for 2013. And although it's optimistic, I mean, the forecasts are up. It looks like things are going to be a little bit better as far as employment, as far as new housing starts. But it's still a pretty flat market.
It is, and getting into the material, what's some of the stuff that we're going to be talking about tonight? I know that we're going to be talking about venture capitalism, talking about that a little bit. We're going to discuss the 3.8% that Uncle Sam is going to be taking on real estate transactions. We're going to try to get to the bottom of that. Again, we're going to be speaking on the recovery for sure. And then we're going to be getting into some facts that was published by the National Association of Realtors, stuff that really does pertain to the housing market. You know, if you're out there and you're looking for something to do with your money, even if you're a first-time home buyer, you want to make wise decisions with your money. Things are different now than they were before the housing crash. There's less money now. You got to be smarter with your money. This is really a way that anybody, you know, a consumer, an investor, whatever you want to call yourself, by delving into this information, this is a way that you can make better decisions with your money. And at the end of the day, you'll be looking a little bit prettier.
Real good. So let's go ahead and get started here, Keith. And this is, you know, one thing that we've kind of been talking about a little bit. Private equity really hitting the market hard, and this is pertaining to real estate. Cash sales 2012 are running around 40%. So 40%, 4 out of every 10 closed transaction is cash sale, and that's up 10% from 2011, which is really quite a bit for 1 year.
It's something that we've really noticed personally with our business. I mean, a lot more of our closings now are cash. And it's not, you know, just, you know, someone that has a bunch of money looking to spend it. I mean, it's, you know, in some cases it's people that might be buying homes for their kids, you know, and they decide to pay cash for it. Maybe a mom or dad thinks this is one of the best things that I can do for my children's future is to buy a house. I had a lady that actually got hurt and won a settlement, so she decided to take her money and buy a foreclosure and pay cash for it. And her thoughts were, you know what, if I keep it, I'll spend it. If I put it in the stock market, I might lose it. One thing that I can do with this money to really help myself in my future is to buy a house for cash. She's paying less a month in bills. She has a roof over her head, and she really put herself in a better position down the road by doing so.
And you hear a lot about private equity that's on the sidelines. I know we read some articles that say that there's trillions and trillions of dollars that are not really being invested. And we feel like some of these people that maybe have deep pockets, you know, private equity funds, which we're going to talk about a little bit, are really starting to think real estate is a safe, you know, long-term and short-term place to leave their money.
And if you look at what's happening, you know, with the fiscal cliff and the shaky economy, and, you know, if we feel that some of the other markets definitely are going to be affected a lot worse than real estate, the fiscal cliff is going to affect real estate if they don't get a deal nailed down. We're going to be talking about that a little bit tonight. But, I mean, again, you have people out there that might be sitting on this cash, and people might be getting a little bit nervous thinking about inflation coming. And what do you do with all your cash? Buying real estate, we feel, is about as good as anything that's out there.
Well, that's what, you know, a lot of these venture capitalists are thinking. And this data is actually U.S. venture capitalist investment by year.
What is a venture capitalist first?
A venture capitalist is someone that goes out and raises private money in order to start a business, to buy a piece of real estate. I mean, there's a lot of companies that you've heard of that are actually started by venture capitalists. FedEx, for example, was started by private money. There's a handful of them out there that grew into giant monster companies Someone took a bet on FedEx, just the same way as someone takes a bet on real estate, and if they hit a home run, then they can make a ton of return. And we see that right here. You look at the one-year returns. Private equity investors are averaging 22.5% versus the stock market, which is pretty much beans. Yeah, not that great. Also notice the difference, the jump in U.S. venture capital investment from just 2009, 2011, 28.4 billion. We got this information from Investopedia.
So you do have, and according to the numbers, you have people that now, specifically venture capitalists, that are spending more and more money per year on real estate. And what not that all of our clients want to become venture capitalists or even work with venture capitalists, but if you're sitting on the sidelines and you're watching, you're thinking these guys are putting more money year into year into real estate over the last several years. It does make you think that there is a rebound on the horizon, that things are going to start to level out, and that there's money to be made in real estate.
You would think that these companies, individuals that can go up and then go and raise millions and millions of dollars from investors, do some research.
You would think so.
You would hope so.
You probably think there's some smart people.
Yeah, you would think so. So anyways, we thought this was an interesting point. Wanted to get into that briefly. Foreclosure trends. 1 in every 730 homes.
And that was a 2012 number?
Yes, correct. And the hot spots are still, hasn't changed, California, Florida, and Illinois. 54% of U.S. metros post quarterly increase in foreclosure activity. We thought that was something worth mentioning also.
For sure.
First quarter foreclosure activity, this is the first quarter 2012, increase from previous quarter in 26 of nation's largest metro areas. So even though nationwide the foreclosure rate is starting to slow a little bit, it's starting to uptick a little bit in the metro area.
And the cities in particular.
Maybe something that we'll see more of a trend of.
And and then maybe less foreclosures in some of the outlying suburbs, type areas.
3.8 real estate tax, and this is the tax that everybody's been hearing about in the news.
It's the healthcare thing.
The healthcare thing, and we wanted to we actually pulled an article from Realtor Magazine, and I'm quoting Realtor Magazine. The tax doesn't target real estate and will, in fact, affect very few home sales because it's a tax that will only affect high-income households that realize a substantial gain on an asset sale, including a home sale, once other factors are taken into account. Maybe 2 to 3% of home sellers will be affected. So it doesn't sound like it's going to be something that's going to affect too many people. You have to realize a gain for an individual of at least $250,000. For a family, it's $500,000, which in today's market, even in the luxury market, more high-income type homes, those type of gains, we're just not seeing them that much anymore.
True.
And then also there's qualifications as far as income. If for an individual, if they're making $200,000 a year, then this tax could apply to them. For a family, it's $250,000 a year.
So it is targeted towards the people that are making the more money. But something to think about is this is a tax that is going to start eating away at the capital gains tax on the household sales that's been in effect ever since we've been in the business.
Right.
So it looks like that, at this point, that tax is on the table, which isn't necessarily a great thing, for sure, especially when you're looking at a real estate market that's still a little bit shaky. That's maybe starting to limp along a little bit. It's not super exciting for us to think that Uncle Sam is going to be taking more out of the proceeds of the sales. But, again, you're talking about very few transactions.
National Association of Realtors, they don't support the tax because it was added into the health care law at the last minute and never considered in hearings. But they're not advocating its repeal at this time. So I guess they don't really feel like it's a big enough deal to really try to get it repealed.
And we want to mention this too. This is not a political broadcast. We obviously have our political beliefs. We like conservative government, but what we're trying to do here is we're just trying to sift through all this stuff. Whether you like the leadership, whether you don't like the leadership, it's still in place. If you're a business person, you got to move forward, and that's exactly what we're trying to do.
So we're going to get now to the National Association of Realtors Economic Forecasting, and we came across this information, thought it was great, and wanted to share it with everybody. And I'm going to pull this PDF to bear with you for just a moment here.
We have quite a bit of information here. We're going to go pretty quick to get through this. We typically like to keep these presentations well under an hour. Number one, we don't want to keep anybody all night. We're not going to sit here and go on and on for hours and hours at a time. So if anybody misses anything, feel free to contact us. We would love to discuss this information with anybody. Obviously, this is what we do for a living. If anybody wants a copy of this presentation, we'd be more than happy to send it. Just send us an email, give us a call, and let us know, and we'd be happy to share it with you.
Also, for those that would like to share, we want to mention this too. All of our webinars, including this one, will be recorded and put on YouTube, also iTunes. So you can hear them. You can go to iTunes. You can download them on your phone. You can go to YouTube and watch them or share them anytime you like. So let's get into some of this information, this economic forecasting. You can see that it was updated October 25th. So this is very current information, which is great. Okay, the economy. This has to do with real GDP growth and nominal GDP growth. Real GDP growth in the second quarter was 1.3%, which is subpar. Now, real GDP is a measurement of everyone's and every entity's income, all combined after subtracting away the inflationary portion.
And this is the country.
This is the country. This is the country on the whole. Nominal GDP is raw dollar figures, no adjustments for inflation. They show revenues are rising by 4 to 5% in 2012. So really not too bad. We got to see some revenues going up a little bit.
People are making a little bit more money, than they were after the housing crash, and it does seem like there is a little bit more stability in the marketplace now.
And when I look at this chart, you really just see, look what happened in 2009.
See that dip.
My goodness. So it's we're coming out of it a little bit, which is good. Slow, steady growth. You got to be happy for that right now.
Better than no growth at all.
Absolutely.
Better than what happened, back in 2008, 2009.
Payroll job changes. Payroll jobs are based on figures reported by companies. It does differ from household employment figures, which are based on survey of households and not companies.
Because not everybody works for a company,
Exactly.
Obviously. There's a lot of stuff. We're self-employed
Exactly correct.
as realtors.
Now, the forecasting, saying net new payroll additions of 114,000 jobs occurred in September. The forecast calls for 1.7 million new jobs 2012, and then accelerate to 2.2 million jobs in 2013.
This is good news. But there's a little bit of a dark side to this, which we're going to get into tonight. The country and the companies are adding jobs, but unfortunately, the labor force that's participating is shrinking.
Quite a bit.
So we're going to talk a little bit more about that.
And this is total jobs. This is payroll versus household. And this goes back into what you were saying. This just shows the comparison of payroll jobs, which are what's reported by companies, versus household. Basically, when the census does, when they do their thing, the people that, like us, even though we're not necessarily employed, we still say, yes, we have a job.
Sure.
So there's a little bit of gap between the payroll versus what the household is, and that's really all this graph right here is showing.
And you can still see, how it has gone up, through the years. There's been some minor dips, but you do see quite, a steep decline as you're getting into that 2008 and 2009, and then kind of a little bit of a slow, steady growth, and especially what's being forecasted for 2013.
Well, according to this data, roughly speaking, about half of the jobs lost during the recession have been recovered so far. Interesting. Okay. Unemployment rate. This has obviously been a hot button. Unemployment rate is simply the number of unemployed people divided by the number of people in the labor force. The unemployed people have to be looking for a job to be counted as being in the labor force.
And that's the key. You do have to be actively looking for a job, and that's something that just kind of blew us away whenever we started getting into this information.
So the forecasting, as far as that goes, the unemployment rate declined to 7.8 in September, and it should remain around 8% for most of 2013, even with the new jobs, because the labor participation, the force will edge up a little bit. So that's something that you hear a lot about the unemployment rate in the news, just a ton, but you really don't hear a whole lot about the labor force participation, and it's really something that we got to think about when we're looking at the unemployment rate.
Absolutely.
People that aren't working, they're not making any money, they're not paying any taxes, they're still living, they're still eating.
Most of them are starving.
Absolutely. And this is it, the labor force participation rate. you can see that, it's just steadily gone down. I mean, and this is, again, it's not only people that took early retirement packages and they're no longer counted in labor force. Some went on disability.
Right.
Some.
Yes.
So that number's going up, obviously. According to this, the labor force participation were to be normal or had not fallen, and then corresponding unemployment rate would be closer to 11%. Okay, so, maybe the unemployment rate's really not as great as it's really showing. Even though 8% is not a fantastic number by any means, if you take this out of the equation, it's probably looking like a whole lot of a worse picture.
Yeah, it looks like 1 out of 10 people aren't working.
Absolutely.
And then that hurts us. That hurts housing, in a roundabout way. No doubt
it does.
about it, even though there's entitlement in housing.
Consumer price inflation is what it costs to buy things. Now, the all inflation accounts for food and energy prices, so that's going to be your blue line right there. The core inflation subtracts food and energy, the food and energy component, because food and energy has been very volatile. The prices go way up and down, obviously.
Yeah, you look at the blue line and you see the big drop in 2009 when gas prices went way down, and then you see how it spiked going into 2011 with the high gas prices, and the high price of groceries.
Absolutely. We're paying more for fuel, we're paying more for energy, we're paying more for groceries. So I think that's really something that needs to be considered, in my opinion. But this is something that's very interesting and really kind of hits home for us, that the rent, in essence, what renters are facing, though there are assumptions regarding what homeowners would pay for the rent of their own house, but the rents are going up.
Rents are going up
quite a little bit.
And we're going to get into this information a little bit more a little later tonight in the presentation, but it looks like that, if nothing changes, that really rents could potentially start to drive inflation.
They could definitely drive inflation. Inflation really hasn't been an issue since 2012 because of the bad economy. But rising rent holding up the core inflation rate. According to this, they said that this could affect the Fed's announcement of its willingness to tolerate. They don't want inflation of 4 to 5%.
And they're going to keep the interest rate at 0 till 2015.
They want to,
from what they've said. But very interesting. When we get into this, is to consider that if rents continue to go up and people have to pay more and more for housing, then the Fed might be forced in a way to raise interest rates earlier than they anticipate.
That's what this data is saying. So the Fed funds rate, one of the primary instruments for the Federal Reserve to steer the economy, it's short-term borrowing rate between banks, okay? And that is the blue line that you see here on this graph. So look what happened since 2009.
0 since 2009.
Yeah.
So basically this means that these banks can borrow this money and it doesn't cost them any money.
They can borrow money from the government. They can borrow money from each other. There's no interest on that money. And that's it hasn't been an issue yet because there hasn't been any inflation since 2012.
And honestly, even though these big banks have been able to borrow this money, it really hasn't led to any loosening in the mortgage market.
Correct.
It really hasn't. So it's almost in a way that even though the banks can borrow this money, they're still very hesitant to put the money into housing and put the paper out there on the street, so to speak.
And they're trying to combat it. You can see that with the 10-year Treasury. It's just going down and down, and also mortgage rates. They're trying to combat it, but how long can that last? As soon as there's any type of housing shortage and renters are going to be willing to pay more for property, which we're going to see.
And it seems like we're already starting to see that.
We're starting to see it
up across the board.
All the data we're going to talk about points towards that happening. So as far as forecasting, despite public statements by the Fed to keep interest rates low, the Fed fund rate may need to be increased in early 2014. Core inflation rate is already above its desired pace and is anticipated to rise higher because of rent increases. So that's huge.
So if you're out there and you're thinking about being a landlord, who doesn't want to be a landlord if you can wield that type of power? You talk about an investment that can curb against inflation whenever the landlords may actually take part in what's happening with inflation or what's happening with interest rates. Tell me that's not exciting for people that own rental property. It is to me.
Absolutely. Absolutely. So housing starts. And this is something that we've really kind of focused on over the last couple of years. We've talked about housing starts a lot because they're so low, for one thing.
Historically low.
Historically low. Housing starts measure the number of newly constructed homes. U.S. population grows generally by 3 million a year. Though they have slowed, it's estimated that it grew 2 million in 2011. According to this information, based on population, need to replace some of the demolished housing units. Most economists believe about 1.5 million housing units need to be built each year. That also happens to be the historical average. But in a given year, housing starts can be much different from average. Recent years, new home construction has been well below the norm. I mean, it's been so low, according to what we've studied and the research that we've done, it's been lower than it's ever been since they started tracking this.
And this isn't new. It's been this way for several years.
It has been. I mean, you can see in the single-family, new single-family housing starts are noted in blue, and then the multifamily in the red or burgundy or whatever color that is. And it's unbelievably low. So what is this going to mean? It's going to mean a housing shortage.
Eventually, it has to catch up. The population right now isn't really growing, isn't really shrinking. But eventually, people are going to run out of places to live.
And it could continue like that. Although starts have been rising, they're up 25% so far this year. Falling inventory means builders need to ramp up production. But a lot of small home builders, there's just no loans for them. There's no money.
Look at the forecasted gap between multifamily and single family in 2013. I mean, that's not really something to consider. Are these builders out there? Are they building subdivisions, or are they out there building apartment complexes?
Well, we did a podcast on this several months back. But there's the vacancy rate on apartment units nationwide was around 45,000 vacancies nationwide, which is just unbelievably low. So again, you got to really start thinking about that housing shortage. How's that going to affect not only the real estate market? How's it going to affect the economy as a whole? Because it will affect inflation. So starts, again, some more forecasting. Starts will rise by 27% in 2012, followed by a 45% jump in 2013. One thing that not only the fact that there's no construction loans out there, but another thing that's really hurting builders right now is the price of materials. Commodities, labor, lumber, bricks, even the price of labor is all going up quite a little bit, right?
Definitely.
And that's certainly it's more expensive to build a house now. And that's, again, something that we're going to talk about because we're going to go over some information as far as existing home sales versus new home sales. This is maybe something that could help to propel the sale of existing homes a little bit more, particularly the distressed properties.
Sure. And and even back to that point to kind of drive that home, this is something that we've been talking about, and it's one reason that, as far as us, we think that rehabbing is really the way to go instead of trying to build if you're an investor. I mean, you have a home that's sitting there. There's a lot of brick homes in St. Louis. And, there actually are commodities in the house. There's copper pipes in the home. There's wood in the home. There's tile in the home, et cetera, iron, whatever the case is. So with the commodities market remaining very high, if you can take your dollar and instead of invest it into commodities or futures or whatever the case is, you can buy real estate, you're actually buying commodities and you're buying it at a rock bottom price. So it's pretty neat to think about it whenever you consider it.
So good market for rehabbers.
Good market for rehabbers.
And landlords, which we've established.
And it looks like that's going to continue.
So new home sales, what's going on with new home sales? This is a measure of contract signing. It says at the moment, census, they don't publish the actual closing figures of new home sales. Not all single-family housing starts are counted as new home sales, which explains the gap between starts and sales. You notice that gap right there versus new home sales versus starts. They don't actually record all the sales. These are just the sales that they're going to find in the MLS, right? So as far as forecasting, new home sales have been rising. We talked about this, 25% so far in 2012, and it's going to go up another 50% in 2013 to about 575,000. I mean, that's still well below the peak, which we saw in 2005 of 1.2 million, which was just too much. I mean, there was just
too much.
There was just too much
money in the market.
There's still a lot of that inventory that's still on the market. Believe it or not, there's a lot of houses out there that never got finished. A lot of builders out of business, a lot of builders got foreclosed on. Now those properties are distressed.
They tore condos down right across the street from our office here in Weldon Springs.
They sure did.
Unbelievable. They tore them down. Makes you kind of feel sorry for anybody that bought in there.
Absolutely, and this is a good real estate market compared to probably most, for sure. So existing home sales, this is what's going on with existing home sales. Again, this is a measure of actual closing all home sales that are not newly built. It's an estimation based on MLS sales count, but benchmarked periodically by the census to make sure that the data is correct. Okay. So again, the forecast is showing that existing home sales are going to go up. And this is one thing when I look at this that you always think about what's happened over the last couple of years. And you look right here in 2009, 2010, and those were obviously the real rough years. Now, 2009 up a little bit from 2008. That was that tax credit at work.
Absolutely.
Right there. And we talked about this back in 2009.
We didn't like it.
We didn't think that they should bring it back in 2010. And I not to say that we're always right, because we're certainly not. But I remember talking about it whenever they were talking about bringing it back, and they decided to. And we came out and said, we think it's a mistake. We should let it go, because all they really did with the tax credit was really just kick the can down the road.
It did.
And obviously you can see in 2010 it wasn't effective. The $8,000 that they gave away wasn't effective.
It didn't work in the long run.
It didn't. It didn't work in the long run. I guess any time that you try to subsidize or pump money into the housing market,
or
any market, which the government's always done.
Sure.
But it just doesn't have that great of effect. At least in our opinion.
We really need a market that rolls with supply and demand. I mean, that's what's going to make a market healthy. And the fact that the housing starts have been so low over the last couple of years, we think that there's going to be some pent-up demand.
And the forecasting is looking good. Existing home sales have been rising roughly 8 to 10% from a comparable period a year ago. Shortage of inventory in some markets and excessively tight underwriting standards are hold back to potential bigger gains. Okay. And this is something that we kind of talked about, even when you look at the visible housing inventory, which we're going to get into next. This is a comparison of existing versus new homes. Look at the new homes. Just look at that. I mean, oh my goodness, you can't get much more of a flat line than that.
Not a lot going on there, is it?
Not at all. So the inventory of newly constructed homes continue to fall, essentially to a 50-year low. The existing inventory has also been falling with today's level at the lowest since 2005. So we have the blue line is the existing, and then the red line is the new. Now, this is something that we talked about. I mean, what's this going to mean for buyers? When the inventory continues to shrink, what's going to happen? There's going to be a shortage of inventory. So are we still going to be in a buyer's market?
Yeah, I mean, we are now, but that could substantially change.
I think it'll change. I think it'll change very quickly.
I think it'll change over the next year to 2 years.
Absolutely.
Quite honestly. And there's actually an article that today actually came out on CNN Money, and the title of this article is "There's a Home Price Recovery, but it's really, really slow." And they're blaming a couple different factors on why it's so slow. The first is the fiscal cliff. People don't know what to do. People are scared about the fiscal cliff. There's actually a Bush-era tax cut on capital gains that's going to expire if they can't reach a deal, and it's going to allow the tax rate to increase to 20% from 15% on January the 1st. So you're going to be paying more capital gains taxes right away. That's going to affect people that are looking to buy and sell homes. And also, there's a mortgage interest tax deduction. Back in 2007, there was a debt forgiveness act that was put into place. So anybody who was short selling didn't have to pay the income. They weren't going to get 1099 on the loss. Okay, and now at that point, that also is set to expire January 1st. You love it, you hate it, whatever the case is. I mean, it's going to expire. So what's that going to mean for someone that is potentially underwater and they're trying to short sale their house? They're going to be a lot less likely to short sale and more likely to walk away and foreclose. Because they don't want to pay that income tax. They don't have the money to pay it, and they can't, basically. So you might be looking at, even though the government in the past year, really has been saying, we had Chase come in the market, we had Bank of America come in our market this year. Oh, short sales, that's what we're going to do. We're going to be doing double the short sales that we are foreclosures. They say that, but then if they can't come together and get the fiscal cliff worked out, is it reality or not? It looks like it really isn't.
It almost seems like there's been one thing after another, that's held us up this year. the election, now the fiscal cliff. You almost wonder what's going to be next.
It almost looks like the left hand doesn't know what the right hand's doing, or whatever, you know. But this same article, you know, does say that that the home prices are going to start heating up towards the end of 2013 and into 2014, and it expects prices to climb 3.4% in 2014, and then an annual rate of 3.3% over the next 5 years through 2017. So the forecasts are good. I mean, even despite the fiscal cliff, you know, it looks like the fiscal cliff is going to be a little bit more than a bump in the road whenever you're looking at housing if they don't get it worked out. But it still does look like that housing is going to start to recover over the next 5 years.
That's good news for owners, for sure.
It really is. It really is. And it has to happen. I mean, these are forecasts, and I mean, you never really know what's going to happen. But if you analyze this data, you take a look at it, again, it really can help you to make a decision. And if you're on the fence right now as to, you know, should I buy, should I not buy, you know, are you scared of the market, the window is going to start closing.
This is something, you know, getting into the next slide here. Shadow inventory, this is something that we've talked a lot about. And these are people that are seriously delinquent with their mortgage, and the home's in a foreclosure process, but the trustee deed hasn't been filed yet. So these are the people out there that basically are staying in the homes and not paying.
This has been the elephant in the room ever since the crash. The shadow inventory basically means, you know, all these loans out there that haven't been foreclosed on yet. And the government, the big banks, National Association of Realtors, nobody really knows. I mean, nobody really knows how many foreclosures are out there. Nobody really knows how many people aren't paying their mortgage. People aren't paying it because they lost money on their house. People aren't paying it because they can't afford to pay it. People aren't paying it because they're pissed off. I mean, you just never know. But this is really, as far as, you know, the forecasting and figuring out when and how the housing market is going to recover, this is one of the things that makes it very difficult.
It does. I mean, it's kind of scary, to be honest. You know, let's talk about someone that you know, they can't make their mortgage. What are their options? They can either just go ahead and walk away and get foreclosed on,
which kills their credit.
Kills their credit.
You know, it's worse than a bankruptcy. Your credit's toast for 10 years, up to 10 years. With a foreclosure, nobody will give you a loan to do anything.
And, you know, walking away, it's just not something a lot of people want to do. You know, walk away from a promissory note.
Exactly.
But, you know, another option is deed in lieu. What's a deed in lieu?
A deed in lieu basically is where you're giving the property back to the bank. You know, so it's a way that you can get off the deed without having a foreclosure. And there are, you know, not everybody's going to qualify for a deed in lieu. There's going to be certain specifications that the banks and lenders and servicing companies are going to require in order to get these deeds in lieu pushed through, similar to a short sale.
But the deed in lieu is a little bit of a better option for the homeowner, and it's probably a little better of an option for the bank.
It doesn't destroy the homeowner's credit. And then for the bank doesn't have to go through and run the whole foreclosure process, you know, where they have to file the trustee's deed or they have to go to court in the judicial state.
So there's some cost as far as that goes to the bank.
For the banks and the servicers, correct.
Okay. And then your third option is going to be a short sale.
Short sale, and if there's anybody out there that is in trouble, the short sale usually is going to be the first option that you're going to look at. And, you know, what a short sale is, for those of you who don't know, I'm sure most people are pretty common with this term by now, but you're asking your lender or your bank to take a loss on what you owe them. So if your mortgage payoff is $120,000, and what you're going to do is you're going to market the property for $90,000 or $80,000, you're going to get a contract on it, and you're going to ask your lender to take a loss on it.
Okay.
And that goes back to the Debt Forgiveness Act of 2007 that's due to expire.
But obviously, according to the information that the National Association of Realtors have here, I mean, there's 3 million homeowners out there that are facing one of those three options at this point. So
the distressed market is not going to go anywhere anytime.
It doesn't look like it. It really doesn't look like it from this data. Median home price. The median price reflects the middle price of all homes sold during a period. It's a good gauge about home price appreciation and depreciation. Now, it can be skewed a little bit based upon you know, some more luxury homes sell. It skews a little. It does skew this data a little bit. But new home prices are also to a greater degree impacted by changes in the cost of construction, such as commodity prices and labor costs, which is what we talked about.
And you're always going to pay top dollar for a new home. typically.
Yes.
You know, and that's one of the things too that has forced so many builders out of the business. Is that, I mean, historically making money building homes, it's been you're making pennies on a dollar to begin with. You know, and now the fact that the homes are much harder to sell, the carrying costs are much higher, that margin has continued to decrease, and that's why you have a lot of people that just aren't building homes anymore.
And even the builders that made it through the crash, I mean, it's mostly just the big nationwide builders.
You got the big ones, then you got those little boutique shops that really are doing one certain thing. They're building luxury homes. Maybe they're building lofts, apartment complexes, that type of thing. These guys that went through and developed subdivisions and put all these homes up, that's not happening, you know, anything like it did before the crash.
Right. So as far as the forecasting, the prices have increased in more markets, which is really good news. Nationally, prices will rise by 6% in 2012, followed by another 5% gain in 2013. So that's good. We see prices going back up.
That's what we want. That's what everybody wants. And it's, you know, again, these are forecasts. There's a lot of different things that need to fall in place in order for this to happen, but it still is good news that it's on the horizon.
And this is, you know, goes back to what we were talking about earlier. Low inventory, low housing starts are a key reason for the price gain. You know, so whenever that supply starts going down, it's going to happen. They put on here that Phoenix could see better than 20% appreciation in 2012.
Unbelievable.
What do you think about that? I mean, Phoenix was just a market that really got just killed.
They got flushed.
Foreclosures everywhere. I mean, you know, I guess for the people that made it through and held on to their property, good for them because they're seeing some appreciation. So this is just a summary of everything that we talked about tonight, and I'm going to go ahead and close this PDF down.
And that's all the information that we have tonight. I mean, we would love to discuss this with anybody that's out there. This is not the last webinar. You'll hear some more from the YUEDE team. Hopefully that's good news for most of you out there. We do have a series that we're working on for 2013, and we're going to do something a little bit different this year. We've taken some of our good clients out to dinner. We've you know, worked on them, talked to them, bent their arm, whatever we need to do, but we're going to actually host a couple of webinars where we're going to have some of our clients that do real estate for a living, some of them that don't, and we're going to look into their businesses kind of as a case study. So these are people that have had success in the St. Louis market. The first one is going to be with one of our clients, a gentleman by the name of, and I use that term loosely, trust me, named Chris Winterhalter, and he's a venture capitalist.
He is. And Chris has been in St. Louis since 2008 and had a lot of success. And, you know, we're really happy that he's going to share with us, you know, his business model, what he's doing in St. Louis. He's doing multifamilies now.
He's doing multifamilies now. He's taking his business, and he's going to do some stuff in Cincinnati as well. So he's doing it in some different markets. Really smart guy. And, again, I know that not everybody out there wants to be a venture capitalist, but, I mean, if you look at a guy like this that does it for a living, he's very, very detail-oriented, really, really good at what he does. We're going to talk to Chris a little bit about his business, and hopefully we can share that with some of the people out there.
And the multifamilies, I mean, that's like everything that we talked about tonight. That's probably a very good place to be right now.
You would think so going into the future.
Absolutely.
You know, there's you know, housing shortages. People need a place to live. You know, once inflation hits, what are we going to do with these rents? We're going to jack them up. There's no doubt about it. We'll pay our investments off faster, and, you know, hopefully we'll all be happier down the road because we were in real estate.
Absolutely. So, everybody, thanks so much for taking the time to listen to us tonight. We appreciate you joining us. Again, this webinar, along with all the other webinars that we've made and will make in the future, are available to be viewed on YouTube. Just go to the YUEDE team broadcast. Also, all of our podcasts, all of our webinars are also on the iTunes store. So if you're a member of the iTunes store, you can find it there as well. If you have any questions, you know how to contact us. And thanks again for your time. Everybody, have a great night.
Thank you.